Red Cloud Financial Services is your preeminent source for mining industry opportunities. The team provides a unique, tailored marketing program dedicated to reaching the right people from its mining-focused global network, giving clients access to industry-leading events and conferences, retail and institutional marketing, plus an in-house growth-driven digital agency. Red Cloud Financial Services has access to some of the mining industry's most notable companies and CEOs.
Hello and welcome to this live core conversation brought to you by Red Cloud Financial Services. I'm Mark Bunting, the host of RCTV. Now, would you like to hear all about gold today in its entirety? I'm sure you would, and we have the perfect gentleman, the perfect guest to do that for us. He is the co-author of In Gold We Trust, which is an annual must-read for people in the gold industry, and we'll get into that as well. Joining us right now is Ronald-Peter Stoeferle. He's fund manager and managing director at Incrementum AG, and if I'm not mistaken, he's in Liechtenstein right now. How are you, sir?
Good evening from Liechtenstein. It's a pleasure. Thank you very much for having me, Mark.
It's great to have you, and we're really looking forward to this. Now, for those who may be unfamiliar, just off the top here, Ronald, could you discuss and maybe just give a brief overview of Incrementum's fund management business, the wealth management side of the business, and also the overriding philosophy and investing style that you take?
Yeah, well, we are an investment boutique managing roughly 400 million Swiss francs. We're partner owned, so I'm one of the 5 equity partners. We've got 7 great employees, so we're still a fairly small team, but I think we are growing, as our name says, really incrementally. We did set up the company 11 years ago in Liechtenstein, probably one of the best and one of the safest jurisdictions within Europe. You probably haven't been to Liechtenstein, but it's really small. It's like 35,000 people. I once did a keynote presentation in Shanghai and said, we're based in Liechtenstein, and that's a country with 35,000 people. And people were really laughing hard because they thought, okay, in China, that's a bus stop, basically 35,000 people, but not a country. But it's a fabulous jurisdiction to do business, conservative in the very best way. And we do manage 6 investment funds, most of them, I would say, in the commodity space, in the real asset space. Obviously, precious metals play a major role. We are very much also driven by the Austrian School of Economics. Sound money is something that we really cannot stress enough. It is a great pleasure working and developing this company. We've got lots of skin in the game, so every asset manager is obviously also massively invested in the funds that he manages. So it is really a company that is, I would say, pretty unique, and therefore I still really, after 11 years, I still really love and truly enjoy working at this company and developing Incrementum.
Now, Ronald, the annual In Gold We Trust report was started in 2007. You're the co-author of it now, and you've got a team of 20. It really has become an industry standard in the gold sector. Why do you think it's become such a must-read for people?
Well, Mark, I think that people can tell that we truly love writing and thinking about gold. It is something very, very dear to my heart. And when I started writing about it, when I was still a young analyst working at Erste Group in Vienna, I wouldn't have thought, back then, that I would at some point publish the probably most widely followed publication on gold. It is published, in German, in English, in Mandarin, and then also in Spanish. And our mission has always been that we want to deliver a sober, fact-driven analysis of all aspects of the gold market. So not only supply demand, but also obviously the macro case, where interest rates going, what about inflation, topics like de-dollarization that became really center stage recently. We cover the technical aspects of gold. We cover topics like ESG, but also more philosophical aspects like the question if gold has an image problem, for example. We had a chapter once about the importance of gold and silver in the Bible. So it is really a long read, and that's 400 pages. That's quite a brick. There's also a compact version, obviously, which is still 40 pages. But I think that the success of the report is really that we receive the most valuable things from our readers, and this is their precious time. And obviously we want them to, after reading the report, saying, well, this was really a good investment. This was time very well spent. So we try to make it entertaining. I think our graphs are really, really good looking, thought provoking. We want to really deliver a product that is different to typical research. And I think that people can really tell that there's so much time, love, capital, and devotion in this report. And you've got no idea how many emails and phone calls I get from all over the globe with people saying, thank you. This was a great read. Thank you what you're doing for the industry. Because, just one last sentence, I think there's way too much gloom and doom type of research, especially in the gold space. And we really want to make a sober case for gold, crunch the numbers, explain why it makes sense for an institutional portfolio, what gold does from portfolio point of view, how the correlations are, setups when gold works particularly well and when gold doesn't work so well. And I think that's quite unique in the gold research space.
I agree. It is unique to have a sober look like that. If I see one more headline that says gold is going to the moon or it's going to crash, I'll pull my hair out. But just quickly here, Ronald, still with the report, I was surprised when I went to Incrementum's website that it's available for free. Am I correct that it's available complimentary to investors?
Yes. So we do have all together for all publications. So it's not just the In Gold We Trust report. We also publish a monthly chart book. We just did 2 specials. The purchasing power of gold, measured in beer at the Munich Oktoberfest, where you have quite a significant annual inflation. And we did the same with the purchasing power of gold in iPhones. And I can tell you, gold does a brilliant job in protecting your purchasing power, measured in beer and measured in iPhones. So altogether, we've got really dozens of publications out there. And we always said we want to publish it totally for free. And it wouldn't be possible without the support of our premium partners that are, the most renowned companies from the gold industry that support our work. And otherwise, it wouldn't be possible to employ 20 people working on all our publications. So it's totally for free. You don't have to register at all. You can just download it on our webpage.
Right. I did notice a lot of big name sponsors for sure. So this year's edition is entitled The New Gold Playbook. And the crux of what you're driving at, and you can correct me if I'm wrong here, is the divergence in gold demand from the west to the east that we've been seeing, that ongoing shift, and also all this central bank buying. And your thesis seems to be that this is not your granddad's gold. Things are different now. Is that, am I on the right track there?
Yeah, absolutely, Mark. The team and I, we sat together beginning of this year, and we said, gold is doing tremendously well, despite the fact that we have seen a surge in real interest rates. So nominal rates were actually obviously rising big time. Who would have expected interest rates to go above 5%? And then inflation numbers were coming down, and usually collapsing real interest rates are like or surging real interest rates in positive territory. That's like by far the worst setup for gold. And then we're also seeing massive outflows from the gold ETFs. And we thought, okay, the price of gold is rising. And back then we were trading at 2,200, 2,300. And we said, why actually can it rise even though we're seeing so many headwinds? So we crunched the numbers and basically came to the conclusion that something that we already wrote about in the last couple of years is really now happening, meaning that the marginal gold investor, the marginal gold demand is not coming from the Western world anymore, but rather from emerging markets. So this is the first part. And Mark, I can tell you, I'm traveling quite a lot. It is something that I truly enjoy, going to Turkey, going to China, going to India, to Dubai, for example, and talking with people about gold, the motivation of holding or selling gold, the infrastructure and so on. And I can tell you that the attitude when it comes to gold is a completely different one in emerging markets. And Louis Vicent Garf said gold is a low beta emerging markets play. So he basically said, if we are right that emerging markets will continue to grow at a faster pace compared to developed countries, and that their demographics will continue to be favorable, this will be a natural tailwind for gold demand from emerging markets. So this is the first part of the equation. And the second part is obviously that starting in 2022, we saw central banks becoming a major driver. Now, what did happen in 2022? Obviously, after the invasion of Russia in Ukraine and the financial sanctions by the EU and the United States against Russia, where they basically said, okay, we are freezing 400 billion of Russian assets. Many central banks and many countries all over the globe started reconsidering their dollar exposure, started reconsidering their FX allocations, their bond holdings. So back then we already wrote this is a real game changer. And 2023 we saw 1,136 tons of gold being purchased by central banks. Starting this year, the first half of the year, 483 tons of gold, which is a new all-time high for a first half of the year. So central banks have really become a major driver. They're now buying almost 30% of annual gold production. And I would say that central bank demand will continue to be a major driver. And our view is that gold is coming back into the system as a neutral monetary reserve asset. And I think this is really a topic that will continue. I mean, we've got the BRICS meeting in Kazan in October now. We've got lots of developments that basically confirm our assumption of de-dollarization, of a bifurcation of the world. After 30 years of tearing down walls, we're now building new walls. And I think that gold is some sort of this neutral reserve asset that can communicate between the two blocks, and where emerging market central banks are still heavily underweight. So this is, from my point of view, the new gold playbook: emerging market, private investment demand, but also jewelry demand. And then on the other hand, central bank demand, also primarily driven by emerging market countries.
That's fascinating the way you laid that out, Ronald. I know we could probably do a whole separate show on the concept of de-dollarization and gold being used to back some kind of new currency. But just briefly, do you foresee gold being used again to back a currency of some sort? And if so, is that a multi-year process? Could it happen more quickly than we think?
Well, again, it might be anecdotal evidence, Mark, but when I was in Dubai, and I held a seminar there at the Dubai Gold Exchange, and if you're talking to traders really large gold traders, and Dubai is responsible for 25% of global gold trade now. I think people aren't aware of the size, of the enormous size of Dubai, for example. And if you talk to people from China, from India, the Arabic world, about de-dollarization, it is not, kind of a conspiracy thing. It is not something that you only read on Zero Hedge or on Twitter. It is something pretty normal to talk about. And they say, well, why does actually Saudi Arabia and also the United Arab Emirates, why are they still pegged to the US dollar? Why are they therefore also having to deal with the same interest rate policy? And I think this growing confidence that emerging markets now have, as they have overtaken the G7 when it comes to economic power. I think they want to be treated well. They want to they don't want to play by the rules that they haven't written. Let's put it that way. And therefore, I think that gold will definitely play a major role in a new monetary, let's say, monetary agreement. But then on the other hand, I don't think that any country really wants to have a gold-backed currency, because this is obviously a limiting factor to every politician. But what gold brilliantly does, it creates confidence in a new currency. So I think some sort of a bancor, so like a commodity-backed currency with some gold, is something that I wouldn't rule out. And I think going forward, we've got the elections coming up, and if you really listen to what not only the team of Donald Trump, but also of Kamala Harris, what they are saying, they actually want a significantly weaker US dollar. They're talking about the reindustrialization of the United States, and they need a weaker dollar. So I would say gold will play a major role, like it always did, in some sort of a realignment of our world monetary system. But I don't think that we will have a gold-backed currency, 100% gold-backed currency anytime soon.
Now, Ronald, you said just a while ago that in the West, gold has an image problem, that certain people deem it useless and dirty, and it's not green. And also there's a perception that the people who espouse owning gold are often right-wing on the political spectrum, so to speak. So are those perceptions difficult to overcome for gold, or can they be overcome?
Yes, I think that's again, Mark. There's a huge divergence between the perception of gold in the Western world compared to the Eastern world. I would say that in China, for example, but obviously also in India, gold has a very, very positive image. While in the Western world, for example, I was in Germany on national TV, there was a comedian. I don't think he's very funny, actually, but he basically said, if you're buying gold, you're a Nazi, which is pretty powerful to say in Germany, obviously. And then, gold is being regarded as something right-wing, only preppers buy gold. I think it has a pretty negative image. And from my point of view, the second part of this negative image, beside the political part, is obviously that gold is being regarded as something dirty, something useless. So there was, for example, a study from the University of Oxford, and they found that perceptions of gold mining as environmentally damaging are extremely widespread. So from my point of view, really knowing the industry and talking to the mining companies, I know that especially the listed companies have done a tremendous job over the last couple of years when it comes to ESG. And I would say that the S of ESG, so the social aspect, is heavily underreported. I think if you visit mines, you can really tell that they're doing lots of positive stuff for the communities. They're creating well-paying jobs. They are providing infrastructure, access to clean water, building schools, hospitals, and so on. So I think it's probably a communication problem of the mining industry. So the narrative, and it's really a narrative, and it doesn't really have to do anything with reality. The narrative in the Western world is definitely a negative one. And you know, Mark, we also have two funds that actually combine gold with Bitcoin. And I can tell you, we got lots of hate from the gold community, but also from the Bitcoin community for setting up these funds. I mean, the results are staggering. It works really well because they're actually quite uncorrelated, which is interesting. But I can tell you, we've seen the same narrative and defamations in Bitcoin as well. Everybody said it's only being used by tax cheats, by organized crime. Then of course it wastes so much energy and so on. So the narratives, from my point of view, are pretty similar. And I think it's really the especially when it comes to mining, I think it's really important to change this public perception. There was another study coming out from Ernst & Young, for example, where they said the mining sector has the lowest ranking when it comes to public perception. So I think it's really important to change that perception with facts, with sober analysis, and this is also what we're doing in the In Gold We Trust report, because I know that gold is a very, very emotional topic, but we really want to take the emotions out and talk about facts, talk about numbers, and just make a positive case for gold. Not the doom and gloom, everything will go to hell case, and also emphasizing the fact that actually the most mining companies are doing a tremendous job when it comes to to ESG and really making not only the shareholders, and they've pretty much failed doing that, but especially the mining communities, providing them some sort of a better life. So I think it's really, really important for our industry to make this sober case for gold.
All right. Well, let's keep our emotions out of it here, Ronald, and get to the price of gold. You brought us some nice charts from your various reports. We saw the central bank gold buying chart a while ago. Now we're going to look at gold inflation adjusted. It's near that all-time inflation adjusted high back in, I guess it was 79.80. But you still think that it is undervalued and cheap. Why do you say that?
Well, I mean, first of all, normally a big bull market, a secular bull market, does not end at the inflation-adjusted all-time highs. So that's the first thing. The second thing is this number, 2,642, is calculated with official CPI numbers. We also know that the calculation of the CPI was changed dramatically since 1980. So I would say that actually real inflation has been significantly higher, and this would mean that the inflation-adjusted all-time high from 1980 should be significantly higher. However, we also have to say that in 1980, this was really a very short spike when the price of gold almost doubled within a couple of weeks, obviously also due to geopolitical turmoil. So, Mark, what is my take is, and I have presented that in my new keynote, I said that, gold is not the super contrarian investment anymore. I remember in 2022 when I was attending the Denver Gold Show in Colorado Springs, the Wall Street Journal had a piece out where it said that gold is not a safe haven investment anymore. They basically nailed the lows in gold. Now we are, according to the Dow theory, I think we're somewhere like, in this public participation phase. We are seeing that lots of investment banks are now raising their forecasts for gold. UBS came out, Goldman came out. So they are realizing now actually gold is making a move. So it is not the super contrarian investment anymore. But then on the other hand, it's definitely not a crowded trade. I can tell you that most of the private banks over here in Europe, they have not participated in this rally yet. When I do keynotes, most of the people would say, would ask me, should I sell my gold now? When I say gold is actually, it's not super cheap, but it's reasonably priced, they shook their heads and don't really believe me. So I would say we're I would say in soccer terms, we're at halftime. Perhaps we will take a breather over the next couple of weeks. I think it would be pretty healthy for the price of gold, but we are not super expensive, and we are not in a irrational exuberance mania phase yet. I think this will happen. This will be the point in time when silver dramatically outperforms gold. This will be the point in time when the mining space, especially the more risky ones, the junior miners, the silver juniors, when they really start outperforming. So that would be my take, and our long-term target that we forecasted based on our Incrementum gold price model is $4,800 by the end of this decade. So in 2030. That might sound like quite a lot, but it's actually a CAGR of, I think, 11% until 2030. I think that's quite reasonable, especially if we should see another inflationary wave. And I think now it's still disinflationary what we're seeing, but we all know how asymmetric central bank policy has been and probably will be. And we haven't talked about the debt situation yet. I don't know what the monthly deficit in I think it was July or August. I think it was $380 billion. That used to be the annual budget deficit. But basically, gold investors are sitting in the same boat like U.S. politicians and the U.S. Treasury, because they simply cannot afford higher rates, and they desperately need higher inflation rates, which should be pretty positive for gold going forward. So to put it in a nutshell, I would say it's a great setup for gold. Still, can we take a breather? Can the next move be $100 lower or even $200 lower? Definitely. But I still think that, especially in the Western world, where we're only seeing very, very slow inflows into the gold ETFs, I think that the Western financial investor will come back at some point. He totally missed the party. And I think this is also one of the reasons why every correction is actually pretty shallow, because there is so much capital waiting on the sidelines, waiting to enter this gold trade, that there are no larger corrections happening so far.
Right. You've mentioned that there really haven't been any major retracements or any major drawdowns the last several months, really, if not going back more than a year or so. So you touched on a few of the tailwinds for gold, the U.S. debt and deficits. You've also now got the U.S. Federal Reserve starting an interest rate easing cycle. And you've got a chart for us as well on this in terms of historically going back, I guess, more than 20 years now, when the Fed makes that first rate cut and how gold does after that. Can you run us through that?
Yeah, I mean, this is a very, very popular chart, and simplicity is the ultimate sophistication, as Leonardo da Vinci said, and we just analyzed the performance of gold 24 months after the first rate hike. And as you can see, it's quite favorable. So gold was up 31%, then 39%, and then 26%. We did the same thing with silver and also with mining equities, also very favorable. So that doesn't necessarily mean that it will stay the same in this cycle. But there's obviously a reason why the Federal Reserve chose to lower by 50 basis points, while the market actually thought it's going to be 25 basis points only. And I would say that, below the surface, they probably can tell that the economy is not doing so well and that a recession might be around the corner. And we also crunched the numbers on that topic and found out that gold is actually a very, very good recession hedge. So gold perfectly works over the course of a recession. Why? Because usually this is the time when central bankers hit the panic button, when rates are being lowered, quantitative easing is being implemented, and there's also fiscal stimulus being implemented. So therefore, I think the next couple of months should definitely have, from the rate side, very, very positive tailwinds.
Now let's get back, Ronald, to this $4,800 price target that you've been forecasting since 2020 out to 2030. And you also talk about how the psychologically big round numbers of $1,000 an ounce, $2,000 an ounce, those took a while to break through. The price would bump his head many times and then finally broke through. So can you sort of run us through that and how this period may be somewhat similar?
Sure. So I well remember 2008. I was still in the bank, and I remember, I think, when Bear Stearns went belly up basically and was taken over. I think that was the time when gold crossed to 1,000, which is the big psychological level. So that happened first. I think it was March 2008, and then we saw obviously the big financial crisis with Lehman going down and AIG and Fannie Mae and Freddie Mac, and we all remember that, and gold went actually down significantly. Many people would say it was manipulated. I think it was lots of distressed selling. Gold is extremely liquid. So what do you want to sell, or what can you sell in times when nobody is buying anything, and when you're facing redemptions? Obviously, you want to sell something where you've got very low bid-ask spreads and something that is traded 24/7. But then actually gold was up, I think, 7 or 8% over the year 2008. And then we crossed the 1,000 barrier only in spring 2009. And you can see on the chart that we tested this 1,000 a couple of times. And then after we broke above it, the price of gold almost doubled within couple of quarters, and we saw the all-time high at 1,900 in summer 2011. If we compare it to the current setup, the price of gold has actually developed this cup and handle pattern for many years, and the price of gold has consolidated actually 4 years, and we've been flirting with the $2,000 level a couple of times, and then it failed again and up again. And And then we actually saw that the name of the last In Gold We Trust report, so the 2023 report, was Showdown. And we said at some point there will be a showdown in the price of gold, and then we will see a really dynamic move, a dynamic breakout. And this is exactly what happened. And since then, the price of gold only knows one direction. We are up almost 30% year to date, which is pretty big. So can the price of gold double over the next couple of years? Definitely. And this is just a comparison, and saying that that it can happen after a long period of a consolidation. And it fits very well with our monetary gold model. So back in 2020, we said, actually, how can you measure or how can you value a good that doesn't have any cash flow? And we said we regard gold not as a commodity, but rather as a monetary asset. So we said, okay, two main drivers of our gold price model, which is the M2 money supply and the growth of M2, and then the implicit gold coverage ratio. So basically, what is the backing of M2 with US gold holdings? And this led us to this probability weighted peak price at $4,800 by the end of this decade. But the interesting thing is it's pretty skewed. So actually higher prices, going from 5,000 up to 12,000, the probability is much higher compared to lower prices. So based on this monetary model, I would still think, compared to the enormous amount of money that was printed over the last couple of years, if you regard it in that way, I would say gold is still reasonably priced. And I have to tell you, Mark, $4,800 by the end of this decade, it still sounds outrageous to many people. But from my point of view, it is actually a pretty conservative price target.
Well, Rob McEwen will love to hear that. We'll be speaking to him once again at the Red Cloud Fall Mining Showcase coming up in a couple of weeks. And I remember interviewing him in around 2015 or so, and he had a $5,000 price target, which sounded outlandish at the time, but you could be right by 2030. Now let's shift gears to gold equities here, Ronald, because you said that the producers are quote unquote cash flow monsters. And I know you've mentioned the names of Agnico and Alamos before, and perhaps during the course of this answer, you could disclose whether you hold those for clients. But also, you've also said that it may be a little early to go all in on the juniors, so that investment money not quite trickling down just yet. So can you elaborate on your positions, not positions, but your view on gold equities right now?
Yeah, well, I think we're really somewhere at the sweet spot for the mining space at the moment. I can tell you, Mark, I had 75 client meetings, so with one-on-one meetings with existing investments in our funds or potential investments, and I really saw that the majority of those meetings were extremely good. So from my point of view, the most important drivers, first of all, we're seeing that cost inflation remains quite subdued in 2024. So I would say that all-in sustaining cash costs will rise 4 or 5% this year. We can see that we're seeing lots of operational efficiencies, moderate wage growth. There were lots of programs to control expenses. So I think all these factors combined have helped to keep operating costs in check. And obviously, with those gold prices, that means that margins will be, enormous this year. And then also in comparison to energy, which is also the ratio between gold and energy is an important driver in our incrementum active aurum signal. Now, obviously, with the whole crisis in the Mid East, we'll see where the price of oil will be heading. But a couple of weeks ago, Brent was trading at 66. And we know that energy is a major driver on the cost side. So that's definitely a very, very positive side. Then we're seeing that M&A is definitely gaining momentum. We've seen, Anglo buying Centamin for 2.5 billion, Gold Fields buying 50% of Osisko Mining. I think there was 2.1 billion. And I would expect to see the large diversified companies like a BHP, a Glencore, a Rio Tinto coming into the gold space, especially into large gold copper projects. So I would say there will be some sort of a strategic shift when major mining companies enter the gold space. That's another important driver. And then I think we're seeing that there's quite a lot of confidence coming from the buy side. Also in Beaver Creek and also in Colorado Springs, an enormous amount of corporate development teams. So it means that the large producers definitely will be active when it comes to M&A activity, and with exploding margins, I think this will definitely increase the appetite for M&A. And then, of course, the mining space is heavily undervalued. Yeah, it's we're seeing really compelling valuations. We're seeing sector valuations with a 40% discount compared to the 10-year average. So I think it's a great setup that we're seeing in the mining space. And then on the other hand, we are also seeing that it's a very, very unloved sector. And this is probably a consequence of the very poor performance that we saw over the last couple of years, where many mining companies made stupid mistakes and really didn't deliver any shareholder value. So, when trust is broken, it takes some time to rebuild that trust. But one thing that might be anecdotal evidence, Mark, but I thought it was super interesting. I was attending a party of a friend of mine, and they were really like very successful, very rich people at this party. And around midnight, my wife said, "Well, let's go. We're tired. The babysitter is expensive." So I said, "Yeah, okay." And then a guy approached me and said, "Aren't you this guy writing those lengthy gold reports?" And I said, "Yes, I think so." And he said, "My fund is full with the Agnicos, Alamos, Franco, lots of large gold producers, streaming companies." And I said, "So you're probably running a mining fund?" And he said, "No, I'm running a deep value fund." And I thought, okay, that's pretty interesting. And he said that within the value community, which is not as loud and as vocal like the gold community or the crypto community, for example. You don't see them on Twitter or on TikTok or whatever. They just prefer reading balance sheets. But he said within this community, there are many people actually realizing that there's a tremendous amount of value on the balance sheets of many mining companies. And I think with Q3 numbers, this will further continue. So I would really see generalists and value players coming back into the mining space at some point.
That's a really interesting anecdote, Ronald, at that party. Glad you bumped into that guy. Just a bit of housekeeping here. You mentioned a number of names there. Do you hold those personally and or for clients?
Yes, Mark. I have to say it is talking about specific names from a compliance point of view. I would love to talk about my favorite names in the mining space, but from a compliance point of view, it's somewhat complicated at the moment. But I can tell you that we are we are really playing very, very offensively in our funds. I can tell you that, for example, in our new fund, which is a very, very active gold strategy, the risk allocation is based on our active aurum signal, which exactly tells us when to play offense and when to play defense. And you know, I'm in this industry for a while now. I lost lots of hair during that, managing mining equities. It's not an easy asset class, but I learned that um, if you're able to avoid the major drawdowns, if you're able to avoid the major bear markets in the mining space, this is actually really the road to success, and therefore we are not, you know, stubbornly long only. We can really raise cash allocations. We can, for example, buy convertibles and also bonds of mining companies. But now at the moment, at our model is suggesting, and it switched on the 23rd of December actually, to a full allocation. Now we're really, we have loaded up our risk profile, going more into the silver space, also taking positions in smaller mining companies. But there will be a point in time, obviously, when the model tells us, well, actually, it's time to be a little bit more defensive again. But I think we're definitely not there yet.
All right, Ronald. Lastly, as you summarize your thoughts, let me ask you here as my last question: is this the best setup you've ever seen for gold in your career?
Is it the best setup? That's a great question. As I've said before, I think it's not a super contrarian idea, not anymore. But I think it is. Gold is being extremely misunderstood, and I think that most people in the Western world have no idea what's actually going on in emerging markets, and you know, how large the impact of emerging market gold demand actually is. As I've said at the beginning, not only from private individuals, but especially from central banks, and you know, central banks, they tend to have long-term buying programs. So I think this will continue to be around, especially with emerging markets having only, I think, 7 or 8% of their total FX reserves in gold, compared to the Western world, which has roughly 19%. And then on the other hand, so this misunderstanding is definitely making me very confident. The second thing is, it is a party that Western financial investors haven't participated in yet. I think it is driven by geopolitics, obviously. That's the whole de-dollarization story. It is driven by recession risks, by the right time in the interest rate cycle. It is driven by, from our point of view, a new or a second wave of inflation to happen at some point. And I think from a you know, from a market point of view, we're seeing classic early bull market action. We're seeing now that miners are starting to lead gold and start to outperform. We're seeing that silver, which is probably my highest conviction at the moment, silver has really stabilized and is starting to outperform gold. We're seeing that all corrections are really very, very shallow, because there's just so much capital waiting on the sidelines. And therefore, I would say, Mark, to answer your question, it is probably not the best setup that I've seen during my career, but it's still a remarkable risk reward ratio, and therefore I would say it's a great setup. However, and I think that's really important to say, gold is not a religion. Gold is not the solution for all our problems. We just put out a special report about the optimal gold allocation. And in terms of optimizing the Sharpe ratio, for example, we came to the conclusion that between 14 to 18% gold allocation is like the perfect gold allocation for a standard portfolio. Now, how many people in the Western world actually really own that much gold? I think very few. And we also said that it's now really time for what we call performance gold, which is mining stocks, commodities, and also silver. And that's, I think, for these asset classes, especially commodities and silver, I think we have seen only a tiny piece of this new bull market yet. They usually, those bull markets in commodities and especially silver, they start with a pretty big time lag compared to gold. So gold is always the first mover. So I would say from a cyclical point of view, it's a really exciting setup, and therefore I really look forward to the next couple of quarters for us on the research side, and especially also for our clients that are invested in our funds.
Ronald, you really are an absolute wealth of information. I can't tell you how much I and our viewers enjoyed this, and we hope to do it again down the road. Thanks again.
Thank you very much, Mark. It's been a great pleasure. All the best from Europe to Canada. Take care, my friend.
Yeah,
Thank you.
have a great night, and enjoy yourself. Go get yourself a drink. All right. Maybe he doesn't drink. I have no idea. But anyway, how great was that? We promised and we delivered. He really was great. If you missed any of that, you can watch the replay on YouTube. And tune in for our next core conversations, which will be coming soon. That was Ronald-Peter Stoeferle, fund manager and managing director at Incrementum AG. Thanks again for joining us, and we'll see you next time.